Hope you're all doing good. In today's session, we'll be covering one specific question which is based on IND AS16 property plan and equipment. You'll be able to find this question as if you open study material, test your knowledge questions are there at the end of the chapter, right? So this question is, or today's session question will be test your knowledge question number 6. Okay. A pretty hyped up question. Many students were asking, sir, we need some help on this. So I'm just making a recording for this particular question. Okay. Yes. So this question is basically about decommissioning and site restoration cost, or we used to call in our class purpose as DSR, right? Decommissioning and site restoration with revaluation. Okay. That's a combo offer. So when you read the question and when you look at the solution, it looks a little hyped up and you may not follow much. Actually, it's a pretty easy question. So some of you might have studied this topic long ago with us, and there are some YouTube audience who may not be comfortable with the concept at all. So to just help them, I'll give you a little background about decommissioning and site restoration costs first, and then I will start this particular question. So for those of you guys who are comfortable with that concept, you can always use that speed control option. We have speed control option, no? 1.5, 1.752 and all. You can use that and accordingly do it. Others who are not comfortable or forgotten about DSR, watch the whole portion. Okay. So yes, for the benefit of our YouTube audience, guys, normally we cover our FR with the help of charts. So for each topic of our index, I've prepared a colored chart book. It somewhat looks like this. I'm just showing you a quick summary or quick sample of our chart books. For all the concepts of index, we have this these kinds of chart book. Through this, it's possible for you to revise the entire FR syllabus within 3 to 4 hours. Easily you can revise. So if you wish to purchase this, not necessary you have to be our students. Okay, if at all you want to just purchase this and benefit from it, you can go to our website learn.reviewpro.com. Okay, log into that, select CA, go for CA final and select books. Once you select books, so select the subject financial reporting, select printed book and select here chart book. Once you select the chart book, you will be able to getting the price of it, add to the cart and accordingly give the right address, the books will be delivered to you. Okay. Now coming back to the concept. Okay. So what is this DSR? So if I'll have to tell you that, so let's take a small example. Let's say there is a company, Reliance Jio, no? They want to. So they are the telecommunication companies, right? So in order to operate in the business, they have to install telecom towers. Yes. Let's say Reliance Jio installs the telecom tower, okay, in one of the office building, let's say worth 1 crore rupees. The worth of this telecom tower is 1 crore just for simplicity. Okay, in a building. Normally, if you just see, these telecom towers and all will be installed in a high-rise building. They require this to get the signals, right? So let's say they have installed this telecom tower in a building for a period of 3 years. See, any random building, Reliance can't visit any random building and just put off their tower, right? They need to take the permission from the landlord, the building owner. The building owner told, what's in it for me? Reliance told, no problem, boss. I will give you some money. Every year, if you allow me to give me the permission to install this telecom tower, no, I will give you, let's say, 1 lakh rupees. Okay. I'll give you some rental cost. And he also said, okay, no problem. Okay, that's good. So they've agreed upon some amount. Now that we're not talking about that. All right. Now, let's say one more question the building owner asked Reliance. You are anyway saying you will install this telecom tower for a period of 3 years. See, this is not just kept. You'll have to uproot it to the ground. That telecom tower has to stay on that building for about 3 years. So you have to properly drill it and make sure that it stays. Yes. So building owner told, after 3 years, you will remove that telecom tower. You will airlift it or you will remove it somehow. Yes. So when you remove it, my building there will be substantial damage cost to my building. Yes. So the building owner told, because you installed that telecom tower, my building is getting damaged. So you have to repair that building is what the owner told Reliance. Reliance owner told, okay, no problem. I'll take care of the repairs. Don't worry about that. Let's say that repair cost, we call it as DSR, decommissioning and site restoration cost. You're decommissioning your asset. You're taking it off and you're doing some restoration of the work because you installed a telecom tower building has, when you remove it, there'll be some damage cost to the building. That damage cost Reliance Jio has to incur. That is what we refer to as a decommissioning and site restoration cost. Let's say that DSR cost is 1 lakh rupees. Okay. But you will incur this. Reliance is estimating it has to incur 1 lakh rupees as a repair cost. Okay. Now, when do you think this 1 lakh will come? When they remove that telecom tower from the building. When will that removal happen? At the end of third year. So that means this DSR cost will be incurred at year 3 ka end. Okay. So this particular treatment, now you know the meaning of DSR, right? Decommissioning and site restoration cost. To restore the asset, you are incurring a particular cost. In this case, you are restoring the building, which is damaged due to installation of this telecom tower. So how should Reliance, which is incurring the DSR cost, how should they account it is the question. So now we have to tell. If you want to look at the journal entry, okay. So if you want, we will pass off the quick journal entry. Let's say the discount factor here is at 10%, again for simplicity. Year 1, year 2, year 3. Okay. I think in the class also I had given the same example, but let's quickly cover it off, no problem. So Reliance Jio has purchased the telecom tower. So the journal entry for that, for Reliance, it's a property, plant and equipment, right? So property, plant and equipment account debit 1 crore rupees. Okay. Let's say to bank account 1 crore rupees. Or 1 minute. I'll just maybe pass off, or it's okay. Let's do a simple journal entry. So this for the telecom tower purchased. Now second, now if you think about it, you got the meaning of DSR. As per IND AS 16, if there is any decommissioning and site restoration cost, that has to be added to the cost of property, plant and equipment. If there is any decommissioning and restoration cost, as per IND AS 16, that has to be capitalized, meaning it should be added to the cost of property, plant and equipment. Why? Sir, you think logically. If the Reliance does not incur this cost, if the Reliance tells, no, I will not pay this, then will they get the permission to install this telecom tower? This telecom tower is their PPE, right? It's a property, plant and equipment for them. Unless they incur this DSR cost, can this asset function the way Reliance wants it? No, they cannot install this tower only. Yes. That means this cost also, this DSR cost also is necessary for the asset to function the way as intended by the management. That's what our IND AS 16 also says, no? Yes. Any cost incurred, any directly attributable cost incurred to bring the asset to the present location and to management intended condition should be capitalized. Yes. So using that funda, this DSR cost should be added to the cost of the asset. Okay. But there is one small hiccup there. You know that this has to be capitalized. But the problem here is this 1 lakh cost, no, Reliance is not incurring now. They're not incurring this at the beginning of year 1. They will incur this only at the year 3 end when they uproot this telecom tower. Only then this cost will come. Yes or no? That means this 1 lakh is not the current value. It is the future value. This is the cost that Reliance will incur at the end of third year. Hence, what the accounting standard says is you capitalize DSR cost, but do not capitalize at the whatever value given. You first find out the present value of this DSR cost, then you capitalize. Because you're doing the accounting now, right? PP accounting initially you have to do, right? Year 1 may you have to do. But this 1 lakh you're incurring at the end of year 3. So use the discount factor, find out its present value. Since the discount factor is 10%. Okay. The journal entry for this is PPE is very simple. PP account debit. Okay. How much? See, this 1 lakh is the future cost. So if you use the 10% annual discount factor, third year ka we need to find out. 1 divided by 1.1 you do. First year discount factor is 0.9090. Second year 0.8264. Third year 0.7513. That 10% I think you must have mugged up by now. Yes, no. It came in your CA Inter FM. CA is 19 of CA Inter. And even in CA final, many discount factors are 10%. Okay. So if you have not mugged it up also, no problem. You do in your calculator 1 divided by 1.1. Press equals to button 3 times. You will get present value, interest factor. Third year it will be 7513. So 1 lakh is the future value. Multiplying the discount factor, you're going to get 75,130. So the PP will be debited by 75,130. Can you credit bank? No. You have not paid this amount, right? You will pay this amount only at the end of third year. So as per IND AS 37, you have an obligation on your head. So you have to make a provision for this. So you will credit provision for DSR account 75,130 rupees. This is the journal entry. It's not necessary these two entry has to be passed separately. Okay, I can combine it also. Just for the simplicity, I've just showed it separately. So this is the initial recognition of PP. So initially property, plant and equipment will be shown at 1 crore plus 75 130. So 1 crore 75 130 is the initial cost of property, plant and equipment at the beginning of year 1 you will record. Okay, all right. Sir, what will happen next? See, simple funda. Okay, you have shown provision at 75 130 now year 1 beginning, but will you pay 75 130? Will you incur 75 130 for this? No, you'll have to pay how much? How much is they are estimating? At the end of year 3, the cost of this provision or amount of provision they need to pay up is 1 lakh. Yes, correct? 1 lakh is the future value. This is the present value. The difference between that present value and the future value is time value of money ka interest cost or finance charges, which has to be transferred to P&L. If you remember, we used to put up this working note. All right, we used to put up provision for DSR. That also, if you want quickly, I will just show it off. Provision for DSR, year, opening balance, then finance charges, payment, then closing balance. At the beginning of the year, okay, provision had a balance of 75 130. Yes, as this is the beginning of year 1. As and when the year passes, you'll have to slowly increase the provision, and from 75 130 it has to become 1 lakh rupees. The difference between that 1 lakh and 75 130 is nothing but time value money ka interest or finance charges, which will be transferred off to profit and loss account. Okay, so that is what, if you remember, in your financial instruments we used to do this table. Many chapters we have done this. You must have remembered this. Or if you feel no, I just started with this topic, I'm not aware of this, means when you do Ind AS financial instruments, Ind AS 109 and leases, Ind AS 116, this table though you will use in many problem. Almost literally in your sleep also, if somebody asks this table, you will be able to recollect. It's so many problems is there relating to this. So I'll just number them as 1, 2, 3, 4 and 5. 5 is equal to 2 plus 3 minus 4. Finance charges, you'll charge it at the discount factor, which is 10%. Okay. So how do you calculate? 3 is nothing but column number 2 multiplied by 10%. Why 10%? Because the discount factor is 10%. Okay. Slowly call this. Okay, 75 130 into 10% if you do, you're going to go, in fact it is 10 you cut off, so it will be 7513. Did you pay for this provision? Did you make any payment towards this provision? No. You'll make this payment only by the end of 3rd year, right? So first year payment is 0. So what will be the provision closing balance? 75 130 plus 7513 minus 0 if you do, you're going to get 82,643. See, this is what? At the beginning of the year, provision balance was 75. At the end of first year, it became 82,643. When the end of 3rd year, it should become 1 lakh. Then it will get closed out like that. Okay. So first year ka closing balance will become 2nd year ka opening balance. So this will be 82,643. Calculate 10% of that. It will be 8264. There is no payment again. 82,643 plus, if you calculate, it will be 90907. Okay. Second year it became 90907. Second year ka closing will become 3rd year ka opening. Then 3rd year, anyway you have to make the payment. No, I'm assuming the provision has been paid out. The payment will be how much? Let's assume that 1 lakh only was the final DSR cost. Whatever they estimated, that much only they paid. Let's assume. So in the payment column, I've written 1 lakh. Okay. So that means this one, no, there'll be a slight round off here. So 1 lakh minus 90,907 you do, you're going to get 9093. There'll be a small, if you actually calculate the interest, it will be 9091. 2 rupee round off error. I've just put it off. So the provision at the end of 3rd year, it's been paid out, so it has become 0. Okay. This we call it as unwinding of interest. Okay. From 75,130, slowly interest kept on increasing as the time passed. Okay. The difference between all this 75 130 and this 1 lakh, no, is nothing but time value money ka interest cost or finance charges. If you add all this, you're going to get that difference. All right. That's how the accounting. So in terms of journal entry, if you require, okay. So what is it? Every year you have to go on increasing the provision, right? So the journal entry for that will be finance charges account debit. This finance charges will go off to profit and loss account or a statement of profit or loss account, which we call it as SPL, to provision for DSR. Okay, first year finance charges is 7513, and then it was 8264 for second year. 3rd year it was 9093, like this. Okay. On this PPE also calculate depreciation, and both finance charges and depreciation will be transferred off to P&L. That I am not showing you. The intention was just to explain you or to give you a recap as to what is the meaning of provision, how the accounting of this provision for DSR happens. Okay, so the example or this quick recap is helpful to you. Okay, this concept is being newly tested. They've added a couple of adjustments to this concept, and they've framed question test your knowledge number 6 in our study material. Fair enough. Okay, so what is the adjustment they have added? Okay, I'll just give you a quick background of that, and then directly we'll dive into that particular question. See, at the beginning of the year 1, Reliance thought this provision, this DSR cost is 1 lakh rupees. That's what they estimated. At the beginning of year 1, they thought at the end of year 3, they'll have to incur some decommissioning cost of 1 lakh rupees. Okay, now the adjustment that they have brought in is, what if it is not 1 lakh? What if that estimate from 1 lakh becomes 1 lakh 5,000 or it becomes 95,000? If this estimate increases or it decreases, what you should do? That is the funda they have tested in that particular question. That's all. Okay. See, simple. Provision for DSR cost, what did you do? You capitalized it initially, right? So you pass the journal entry PP account debit to provision for DSR. So later on, if this estimate changes, what do you need to do? If it reduces means pass the ulta entry, because provision for DSR cost, you're adding it to the cost of the asset. Now you're capitalizing, right? So if provision decreases means reduce the cost of the asset. So this ka ulta entry you pass. Okay. If this provision for DSR balance, if it increases means again you pass off this entry. Same entry you pass it. You have to increase the PPE ka cost. That's all. Okay. That's all it is. Provision increases means increase PPE cost also. Provision decreases means DSR decreases means PPE cost also you reduce. That's all. Okay. Study material has done a slightly different approach there that I will tell you also. But overall, I think you got the hang of what is being asked, I think. Yes. Okay. So with this background, let's do a thing. Let's come back to that question and read it. Along with this, they have also asked some revaluation wala funda. Let's understand the question once and then we'll fully solve it off. Okay. An entity has a nuclear power plant. See, whenever you do some nuclear power plant, hydra projects, or when you extract oil by constructing oil wells and all, no, there'll be some problems. Like if you're constructing oil wells on oceans, there'll be damage to the seabeds and stuff, right? So you have to take permission from the government. What the government will say is, they will give you permission, but they'll put one obligation or one component on your head. What is that? Saying, see, due to you constructing your oil wells to extract the oil, no, there'll be some damage cost to the seabeds. Let's say you're doing this activity for 5 years. What the government will tell is, after 5 years, once your activity is over, once your extraction is over, you'll remove that oil well, right? So that seabed ka damage, whatever has been caused, that also you restore. That the government generally will ask in case of these entities. So that means the DSR cost will be incurred. That's what is happening here also, I think. Let's see. So entity has a nuclear power plant and relating decommissioning liability. So they have to restore this asset. Okay, some environmental damage or something has happened. So they have to restore. Some DSR liability is there on entity ka head. Okay. Nuclear power plant started operating from 1st April 20x1. Fair enough. The plant has a useful life of 40 years. So you will depreciate that property, plant and equipment over a period of 40 years. Initial cost was 1,20,000. Okay, awesome. This included an amount of decommissioning cost of 10,000. So DSR cost, they have already added this 10,000 after adding the property, plant and equipment ka value is 1,20,000. So here we need to add, right? This entry 75,130, we added to the cost of the asset, no? So they're saying this entry is already passed. Okay, this 1,20,000 no, includes this 10,000. Okay, so that means is this the DSR cost? No. This 10,000, what do we add to PP? We don't add the full value. First, we find out the present value of DSR cost, right? So this 10,000 added is the present value of DSR. They only found out. So good question. Last problem, we found out the present value. Here, they only given the present value of DSR cost, which is 10,000, which represented 7,400 estimated cash flows payable in 40 years, discounted at a rate of 5%. So actual estimated DSR cost is 70,400 rupees. But 70,400 you will incur when? When the plant has been fully used and scrapped off. Yes. So when the useful life of the plant is reached, that is 40 years. At the end of 40 years, you need to incur a decommissioning DSR cost of 7,400. We can't add 7,400 to our property, plant and equipment now because 7,400 is the future value. So they found out the present value of that. Okay. And they're saying that is 10,000 rupees and it's already added. Perfect. Okay. entity's financial year ends on 31st March. Okay. All right. Let's do one thing. Let's stop it here. Okay. Till here, let's do off. Okay. Next activity, has happened on 31st March 2020x4. Something has happened. So we are on 1st April 20x1 now. From 1st April 20x1 to 31st March 20x4, if you count 31st March 20x2, 31st March 20x3, 31st March 20x4. 3 years is over. So let's do one thing. This question ka, test your knowledge 6 ka question solution. I'm solving it fully. We'll do off in 2 bits. Okay, study material solution. They have put 2 pages, so many things they've written. Actually, it's a very, very simple exercise. Only 2 components you need to put up, 2 working notes. Okay, one PP ka ledger or PP ka ledger nahi. I'll just prepare a working note which talks about the balance of property, plant and equipment. I'll just write PPE balance. Okay, this is one working note I require to solve this question. And the second working note I require is parallelly, I'll also do working note number 2, provision for DSR account. I'll show it as a working note. Provision for decommissioning and site restoration cost. Only if you put this working note for the 4 or 5 years, okay, your solution is done. That's all you require. Maybe one more if required. Let's see. Okay. So let's find the PP balance first. 1. What is the opening balance or the balance on 1st April 20x1? That is the day asset is ready for its intended use, right? That day PP ka balance was 1,20,000. Okay. We are on 31st March 20x4 now. So from 1st April 20x1, 31st March 20x4 is 3 years. So 3 years has passed means if I have to find out the WDV, so I'll write depreciation for 3 years. 1,20,000 is the original cost. This plant has a useful life of 40 years. If you do this, you'll get depreciation for 1 year. We want depreciation for 3 years. So 1,20,000, if you do this, you're going to get, I think, 9,000. Is it? Yeah, 9,000 is the depreciation. 3,000 is the depreciation every year. For 3 years, it will be 9,000. So what will be the balance? The book value will write. Or the carrying amount on 31st March 20x4. After depreciation, it is 1,11,000. This is PP ka balance still. Same funda, let's do it for decommissioning provision for DSR also. Either you can put up this table which I showed or directly we'll calculate now. Okay, instead of table and all, I'll show you a shortcut method for this. So first, what will be the balance on 1st April 20x1? Present value of DSR, they had only given. How much is that? 10,000 rupees. On 1st April, you added 10,000 rupees as DSR cost to PP. So DSR cost ka balance is 10,000 rupees. Now we don't want 1st April 20x1 ka balance. We want 31st March 20x4 after 3 years ka balance. Now what will happen? Is there any payment in this DSR? No. Payment you will make only at the end of 40th year, right? Okay. As I told you, this is the present value. As the years pass by, provision balance slowly should go on increasing. Now it is 10,000. By the end of 40th year, from 10,000 it should become 7,400 rupees. The difference between this 10,000 and 7,400 is time value money ka interest charges. Yes. But we don't want 40 years now because after 3 years something has happened. So I will just add or I'll directly find out like this. See if you agree with me like this. If I write like this. Balance on 31st March 20x4. I'll just write 10,000 plus 5% plus 5% plus 5%. Calculate 10,000 plus 5% plus 5% plus 5%. If you calculate, you're going to get in your calculator, it will show 11,000. You will get 11,576. In our study material, they have rounded this off to 11,600 rupees. So just to be in sync with the solution, I will do it like the way they have done it only. In examination, you need not round off. You can write full value or write full whatever you're getting. Same thing you can write. Meaning you can write 11,576 itself. Okay. Now for sake of tagging up or tying up with study material, I'm just doing that. This is rounded off. Okay. Fair enough. So how did I do this? See, if you do the table also, you will get the same thing. Yes, no. You need to just add the interest cost because there is no payment here, right? See, in my example, 3rd year you had to make the payment. Okay, here the payment will only come. In this example, the payment will come after 40th year. After 3 years, no payment has happened. So you just have to add in finance charges for 3 years. Whether you put up a table or if you put up a table also, you will get the same answer. But by doing like this, you will get the answer a lot quicker. That's all. Fair enough. Just the finance charges I've added it up. Simple shortcut way. Hope it's clear. So both after 3 years from the initial recognition, we have ascertain the balance of PPE and provision for DSR. Both we have got it. Okay, let's come back to the question now. Assume that the market-based discounted cash flow valuation is 1,15,000 is obtained on 31st March 20x4. All right. So they have given some market value. So that means the fair value they've given. They're saying in the market, if you sell this asset now, you'll get 1,15,000 based on some valuation technique. Okay. Excuse me. The valuation is after deduction of an allowance of 11,600. What is that 11,600? See this one. Provision ka balance. 11,600. Because as year pass by, provision for DSR balance will go on increasing. No? So this balance now is 11,600. That's what they're saying. This 1,15,000, no, they're saying is after deducting 11,600 for a decommissioning cost, which represent no change in original estimate. They're saying after 3 years also, DSR cost is still estimated to be 7,400 only at the end of 40 year. No changes there. Okay, no problem. Check here. What are they asking is, how will you account? The requirement is, if company, how the entity will account for the above changes in decommissioning liability if it adopts revaluation model. We know that, right? As per IND 16. Initially, property, plant and equipment, all PPEs are recognized at the cost model. This goes for intangible assets also. Initially, you will recognize it at cost model. Subsequently, at reporting date, every reporting period end, the company has a choice. They can either go for cost model or they, if you want, they can go for revaluation model. Either they can continue to show this asset at the cost model, meaning go on depreciating this asset and go on showing it. That's a normal one we have done. Or if entity chooses, they can show the asset, the PPE at fair value. That is your revaluation model. And in this question, they're saying, company is saying they are adopting revaluation model. If you want, meaning as a company wants to show the asset at market value, the market value they are saying is 1,15,000. Okay. So let's see what has happened over here. So the book value or the carrying amount of the asset is this much. I'll call this as A. Then I'll call this as B. B is the fair value. Fair value, we'll call it as FV. Fair value on 31st March 20x4. Okay. This is after deducting. After deducting DSR cost. Because they are only saying, no? Yeah. I'm not saying this here, they're only saying the valuation is after deduction of allowance of 11,600 for decommissioning cost. So they have deducted that and they've got this value to be 1,15,000. Okay. Okay, let's understand this now. This is the new adjustment that they have brought in. Now think, sir. You are doing revaluation model for what? For the asset, that is property, plant and equipment. To revalue the asset means to show the asset at the fair value. For that, what do? Compare the carrying amount, compare the book value with the fair value. If there is increase, we call that as a revaluation surplus, which goes off to other comprehensive income OCA. If there is a revaluation decrease, it goes off to P&L. Initially, if there is a gain, you'll transfer it off to revaluation surplus OCA. Initially, if there is a loss, that will be transferred off to P&L account. Yes, fine. So that means what your mind is saying? Sir, 1,11,000 is the book value of the asset. Fair value is 1,15,000. So that means there is a revaluation gain of 4,000. No. That is the small funda you need to be aware of here. Sir, this is the carrying amount of the asset, property, plant and equipment alone. But this 1,15,000, no, 115,000, it is not the fair value of the asset. It is the fair value of the asset after deducting DSR cost. Now, what do we mean by fair value? If you look at IND 113 gives you the fair value measurement. If you have not gone to that standard yet, no problem. What it says is it's the amount received when you sell the asset, or it's the amount paid to transfer or to settle a liability in an orderly transaction between market participants. In simple words, if I'll have to tell you that, if you sell the asset, how much you will recover. If you have to pay off a liability, how much you have to pay. Okay, between unrelated parties. If unrelated parties are selling or buying any asset, okay, when selling the asset, how much you will receive, or if you're on settling a liability, how much you have to pay between unrelated party. That to value we refer to as fair value. Okay, fair enough. So now see here, is the fair value of the asset 1,15,000? No. If this entity were to sell this nuclear power plant to a third party, will a third party give you 1,15,000? Yes, he's saying I'll give you 115. But he also knows, the buyer also knows what? if he buys this nuclear power plant, he has one liability on his headache also. If he buys this, he also has one liability. What is that? Provision for DSR. Because by the end of 40th year, you have to incur this DSR cost, one liability, or you have to make good that. You have to restore the asset. Yes, restore something, and there'll be some cost. There's one liability also you are giving. So what will the buyer tell? Boss, sorry, I will not give you the full value, because along with the asset, I have to take over one liability also, because he's aware of that. Yes. So he'll not give you the full value. So this 1,15,000 is not the fair value of the asset. It is the fair value of the asset after deducting the DSR cost. We want the fair value of the asset alone. What is the fair value of the asset on 31st March 20x4 alone? If you tell the buyer, boss, you buy the nuclear plant from me. Okay, I'll sell the nuclear power plant to you. Don't worry about DSR cost. I will incur it. If you make a statement like this, what will the buyer tell? Okay, in that case, I will not give you 1,15,000. One liability I don't have to incur, no? The liability ka value on 31st March 20x4, don't take this, sir. On 31st March 20x4, the liability ka value is 11,600. That is taken away from buyer. If you take away this from buyer, means the asset ka value will not be 1,15,000. It will be 1,15,000 plus 11,600. That is 1,26,600. So actually the fair value of the asset is 1,26,600. Because you also gave one liability as a bonus, as a free, the buyer is saying, sorry, I can give you only 1,15,000. Okay. But for you to adopt revaluation model, you require the carrying amount of the asset and fair value of asset alone. So these two should be compared to find out whether it is a gain or a loss. That is all is the new funda in this question. Don't take the fair value they have given in the question, because that is after deducting provision. Okay. So since the provision is there, okay, buyer is paying you little less. If that liability was not there on buyer ka head, the amount you would have received by selling the asset would have been much more. How much more? The 11,600 more, because that is the value of liability, right? So hence you need to add that 11,600, that is provision for DSR ka balance. Then you will get the fair value of PPE. That's all. Okay. Right. Now compare this. The carrying amount is 1,11,000. Fair value is 126,600. So fair value is more. So you have some revaluation surplus. So what is the revaluation gain or revaluation surplus? That revaluation surplus will go off to OCI, right? So how much is that? Can I call that at D is equal to C minus A? 126,600 minus 1,11,000, which is 15,600 is our revaluation gain, which goes off to other comprehensive income as a revaluation surplus. Easy. Okay. So after this revaluation, what will be the revised carrying amount? Since you are following the revaluation model, once you do this revaluation, all the assets will be shown at fair value. Okay. So the revised carrying amount on 31st March 20x4 will be how much? Okay, you're showing the amount at 1,11,000. You increase it by 15,600, so it will become 126,600. So can you also tell the journal entry for this? Okay, if you want the journal entry, okay, for this, if you want, we can pass off the journal entry also, if that helps you. From the beginning, we'll do off. If not, particulars, year 1, year 2. I think here 4 years ka data they have given, so I'll have 4 years ka columns. Okay, first journal entry will be your property, plant and equipment. Yes, that nuclear power plant. PP account debit to bank account. Then I'll do a compound entry here. Provision for DSR also should be capitalized, right? So here I'll write to provision for DSR. PP ka cost was how much? 1,20,000. But this 1,20,000 includes DSR cost of 10,000. Means towards PPE you paid only 1,10,000. This is a journal entry in the first year. Okay. Alright. Second entry will be what? This property, plant and equipment you will depreciate. So the journal entry for that will be depreciation account debit, which will be transferred off to SPL. Depreciation account debit to property, plant and equipment every year. That will be 1,20,000. You will depreciate over 40 years. So every year depreciation will be 3,000. Okay. 3 years over for initially. Okay, so hence we took it as 9,000 in this working note, if you remember. Okay, then what happened? This provision, can you show it at 10,000? No. As years passes by, you have to increase the provision balance also. No? So the journal entry will pass as finance charges account debit. This finance charges will go off to statement of profit or loss. So finance charges account debit to provision for DSR, so that you can calculate this. Provision was 10,000 initially, no? So that means if you calculate, it will be 10,000 into 5% first year. It will be 500. I think here there's a small round off. One moment, hang on. Okay. Then if you calculate, or if you want, sir, show us the provision ka, our regular format also if you require. Provision for DSR. Year, opening balance. This is your finance charges. Payment is nothing. And then is the closing balance. Okay, first year end. Opening balance was 10,000. Finance charges you have to calculate at 5% every year. So 10,000 into 5% is 500. There is no payment. So the closing balance will become 10,500. First year ka closing will become second year ka opening. So 10,500 into 5% if you do, you're going to get 525. Again, there is no payment. So this will become second year, it will be 10,025. Third year, or 11,025 into 5% if you do. I think here last year, no, just they've done a small round off just to again sync with the study material. I've just taken it as 575. Okay. Again, there is a small round off here, which you don't have to do in your actual exam. You can take the numbers that you're getting correctly. I mean, whatever number your calculator is showing, you can take it. So if I round off this is 11,600. Actually, this is not the full value. Okay. If you add this, as I told you, no, there'll be a small round off. That's the reason, just to sync up, I've just calculated that 575. Okay. So the amount also I've got 500, and how much is that? 500, 525, 575. That is the finance charges for year 1, 2, 3 respectively. Okay. Clear? Alright. Fourth year, what happened? Or at the end of third year, what happened? You did a revaluation and you got a revaluation gain of 15,600. Due to revaluation gain, you need to increase the cost of the asset, right? PV balance will increase. That means the journal entry will be property, plant and equipment account debit. Okay. To that revaluation gain will go off to revaluation surplus. That gain will go off to revaluation surplus and it will be shown in OCI account. Which year gain came? At the end of third year. How much is the gain? 15,600. So you'll pass this journal entry for 15,600 rupees. This is the funda. Okay. If you had followed accumulated depreciation method, then you can refer our question number 3. Then that accumulated depreciation or provision for depreciation, that you need to reverse. Because there are two ways to account this revaluation surplus, if you remember. If you're following accumulated depreciation method. One, you need to reverse accumulated depreciation or provision for depreciation. And then accordingly pass this particular entry, PPE to revaluation surplus. Or second was increase the gross amount and accumulated depreciation. First, you need to find out the revaluation surplus ka increase. How much has it increased by? 10%, 20%. What is the gain? This gain you got it as 15,600, no? Express that in percentage. Suppose it comes to 20% assumption. Then original amount, the gross amount also you increase by 20%. Provision for depreciation also you increase by 20%. Like this. That is another approach. You can refer question number 3, I think. We have done that. Yes. So I'm not following it here because I've directly charged depreciation to the asset. I'm not maintaining provision account. Study material may they've showed provision. I think that is fine. Okay, you can follow this. This is a lot simpler. Okay. Is it okay? So this is a revaluation gain. I passed this entry. That's all has happened in 3 years term. I think till here everyone is comfortable. Okay, let's come back to the question now then. Third year you got a gain. Okay. Alright, after unwinding of 3 years discount, which we've already done. On 31st March 20x5. Okay, on 31st March 20x5. We are currently on 31st March 20x4 now. One more year has happened. Then they are saying something has happened. Something new has come in. So before that, let's do a thing. One more year ka impact we will give. What impact will come? So one more year has passed means depreciation will be there, no? Correct? So now what will be the depreciation? Okay, so I'll put it off here only. Okay, depreciation for 20x4x5 next year. So when you did revaluation, carrying amount changed because you got some gain, no? Your carrying amount from 1,11,000 it became 1,26,600. Correct? Since due to revaluation, carrying amount has increased. Then do you think depreciation will be same? No. If carrying amount increases, depreciation also will increase. If carrying amount reduces, depreciation also will reduce. Yes, here carrying amount has increased and it has become 126,600. Now this you will have to depreciate. Over how many years? Over the remaining useful life. How much is the remaining useful life? When you bought the nuclear power plant, when you commissioned it, it was 40 years was the life remaining. Now 3 years is already passed. So the remaining useful life is only 37 years. So 126,600 you depreciate over 37 years. So the depreciation every year will be 3421 you're going to get. Study material has rounded off to 3420. Yeah. Alright, so I'm just going to take the same thing. Instead of 3421, 22 in fact you're going to get 2 rupees lesser they've taken as a round off thing. So just I will sync up, I will just put the same value. That is a depreciation. Okay. So after depreciation, what will be your carrying amount? Carrying amount on 31st March 20x5 will be, can I say G is equal to E minus F? That will be 126,600 minus 3420, which will be 1,23,180 rupees. This is the carrying amount you're going to get. Okay. Alright. Similarly, we also find out the provision for DSR ka balance also. You've got the balance till 31st March 20x4. We want it on 31st March 20x5. One more year. One more year passes means one more year ka finance charges you need to add. Yes, no? Provision for DSR component is very simple. As year passes by, go on adding the finance charges to provision account. Year beginning it is 10,000. At the end of 40 year, it should become that 70,000 I think mentioned. No? So that you should increase it. So finance charges here will be what? 11,600 ka 5% if you calculate. 11,600 into 5%, it will become 580. I think 1 minute. This they've rounded off to 600. Okay. Actually, you're going to get 580. This is rounded off. Okay. Don't worry about that. As I said, in examination, you can take the actual value 580 only. Absolutely no problem. Alright. So once you do this, you're going to get provision for DSR ka balance on 31st March 20x5. 11,600 plus 600 if you do, you're going to get 12,200 rupees. This is the provision ka balance. Okay. Before we read the adjustment, we bought all our working note to 31st March 20x5 ka platform. This table I'll not put it up. I think anyway you've got it now. Yes. Okay. Let's come back to the question and read it further. On 31st March 20x5, entity estimates that as a result of technological advances, the present value, not the full value, okay, not the future value. They're saying the present value of decommissioning liability, meaning the provision for DSR now, the present value of DSR has decreased by 5,000 rupees. Due to technological advancement, one happy news we got it. That is, okay, you need not maintain provision or obligation at that value. They're saying whatever is the provision you've got, no, you reduce it by 5,000 rupees. Okay. That's what they are telling it. So the provision for DSR, how much are we maintaining now? Present value on 31st March 20x5 as per our books is 12,200. They are telling in the question, due to technological advancement, this is not so much. You can reduce it. Yes, so provision balance you need to reduce. Yes, less reduction due to technology factors. Okay, due to technology factors, this one of our liability has reduced by how much? 5,000 rupees. That means the revised balance of provision for DSR on 31st March 20x5 will be how much? That will be 7,200 rupees. Okay, everybody. Is it easy? So now, now you need to pay a small attention. Okay, I mean, you need to pay a little attention here. See, when you got provision for DSR initially, okay, 1 minute, let me extra page got inserted. When you got this provision for DSR, you bought the asset and there was one liability on your head called provision. What did you do for provision for DSR? You capitalized it, meaning you added to the cost of the asset. This 10,000 you added to the cost of PP. Yes or no? Correct. That's what you did. Alright. Now this provision for DSR ka present value balance is reducing. So what logically you should have done? DSR cost, since you have initially capitalized earlier, since there is a reduction now, there's an estimate change. Ulta entry you should have passed. Yes, no, provision should have been debited. PP should have been credited. Yes, that's what you should have done for that 5,000 reduction in provision balance here. This one. Yes. But our study material, no. Alright. Instead of adjusting this 5,000 with PP against PP ka cost, They've adjusted this with revaluation surplus. You have revaluation surplus, right? This 5,000, right? They adjusted with OCA, revaluation surplus. All right, quite debatable. According to me, in my view, it should have been adjusted from the cost of the asset. But again, I don't have overriding power over study material. All these are principle based standard. There's no specific comment on this. So even this treatment may be acceptable. In our examination, we will do what study material does it, because all your suggested answers will be based on that only. Okay, that is a small point you need to remember in this question. This 5,000 reduction in DSR should have been reduced from the cost of the asset, but here it is adjusted from revaluation surplus. That's all. Okay, so that means the entry will be what? You have to reduce provision, so the journal entry will be simple. Provision is a liability, it will have credit balance. To reduce it, you will debit. So you will write here provision for decommissioning and site restoration cost, that is DSR account debit. How much? Fourth year you got this drama, no? So 5,000 you will pass this. Okay. But you will not credit PPE account. Instead of that, they are adjusting this with revaluation surplus. So they are writing to revaluation surplus OCA. Okay. In my view, we should have credited PP. But in examination, you will credit revaluation surplus only. As I told you, study material is the trump. Okay, we can't override that. So this is the funda. Okay, that means let's do one thing just for our clarity. No, we'll also maintain here working note number 3. Okay, revaluation surplus account also we will maintain just for our simplicity. I mean for our for our satisfaction. First, when did you get revaluation surplus? You got revaluation on 31st March 20x4. No? So balance on 31st March 20x4 no, was 15,600, because in the third year when you did revaluation, you got a revaluation gain of 15,600. That we have got it. Next year, what did we do? We did some reduction or less adjustments, we will call it. What adjustment we did? There was a provision for DSR reduction, which we adjusted with DSR. In fact, what is adjustment? Check. Revaluation surplus has credit balance. If you just check here, revaluation surplus has a credit balance. Again, if you're crediting means, obviously its balance will reduce or it will increase. Its balance will increase, right? So that means, should I write here minus or plus? I should write plus, yes. So I should write plus 5,000 rupees over here. Okay, till here. So this is the impact. There's one more adjustment, so I'll not write the total now. This is the funda. Okay. This reduction in DSR, they've adjusted with revaluation surplus. So far, fine. So after this adjustment, I found out the carrying amount of PP and provision for DSR. Let's see, one more last adjustment is there. The entity decides that full valuation of asset is needed on 31st March 20x5. They're following revaluation model, no? So annually probably they're revaluing, or they've decided that this year again we need to revalue the asset. 31st March 20x5 mein, again they have revalued this asset. And now to ensure that the carrying amount does not materially different from fair value, okay, they've adopted revaluation model, no worries. 31st March 20x5 also they revalued. What is the revalue they got? The asset is now valued at 1,07,000. So the fair value they got is 1,07,000. But hang on, we already learnt this, which is net of allowance of reduced decommissioning obligation. Meaning, we know this. This is not the fair value of the asset. This is the fair value of the asset after deducting or after adjusting provision for DSR. Why? See, if you sell this asset now, you can't sell the asset alone. Buyer not only will get the asset, he'll also get one liability on his head. What is that liability? DSR wala liability. Yes. So what will he say? Boss, you're not just giving me asset, you're also giving me one liability. So I will not give you full value of the asset. Whatever is the value of DSR, liability value now, that I will deduct. Then only I will give you the price that you ask for. That price they are saying is 1,07,000. How can I tell? They clearly told it is net of allowance for the reduced decommissioning obligation. So they have reduced this DSR cost. After reduction, the fair value is 1,07,000. Same working note we need to do here also again. Okay. So I will write here fair value on 31st March 20x5. But this is after adjusting. This is after adjusting or after deducting provision for DSR. Okay, after adjusting the fair value of the asset, they told us 1,07,000 rupees. So they have deducted provision for DSR ka liability. How much have they deducted? Check how much is the balance in DSR. provision for DSR has a balance of 7,200. Yes, because it is reduced. Don't take 12,200. It has reduced, So on the date of revaluation, provision for DSR has a balance of only 7,200. This much of liability value is there that he has reduced and he is ready to give a price of 1,07,000. So this 1,07,000 is not for the asset alone. It is including liability. But we want the fair value of the asset on 31st March 20x5 only for PP. Only towards the asset, how much is the fair value? Hence, what do we need to do? In 1,07,000 is already deducted provision for DSR 7,200. That you add back. Once you add back this 7,200, 1,07,000 plus 7,200 if you do, you're going to get 1,14,200. So the actual fair value of the asset is 1,14,200. But along with the asset, he also has to take care of a liability of 7,200. Hence, he has reduced 7,200 and he is ready to give you a price of 1,07,000. Hence, that is the fair value. Okay. But since we are doing revaluation, we need to compare carrying amount of the asset with fair value of the asset alone. So hence, these two we need to compare. This is the carrying amount on 31st March 20x5. This is the asset ka fair value. Only asset ka fair value on 31st March 20x5. Same date. These two you compare. Carrying amount in our books we are showing 123, but fair value is only 1,14,000. So that means now it's a revaluation loss. Yes or no? Next is J. So we're getting a revaluation. In the previous year we got revaluation gain. Here we're getting revaluation loss. So can I say J is equal to G minus I? That is 123,180 minus 114,200, which is 8,980 rupees. So this is your revaluation loss. So where will this go off to? So do you transfer this off to P&L? No. We have already read it in the chart. I'll just retrace your memory back in case you've forgotten. Okay. Whenever you do revaluation, first time if you do revaluation and if you get a gain, this is our chart book. We have already written that. Yes. Okay. Just retracing your memory. First time when you do revaluation and if you get a gain, that gain you will transfer it off to as a revaluation surplus. It will go off to OCI. First time when you do revaluation and if you get a loss, first time only, then that loss will go off to SPL or you can call it as PRL. Okay. That is the initial. Subsequently, every year when you're doing revaluation, what you need to do is, if it is gain and loss, what scenario? First year if you get a gain, when you did revaluation, that gain will be transferred off to revaluation surplus, right? Okay. If earlier loss was accounted, then net of that loss through P&L, balance gets to, or maybe we'll take up this scenario. This is relevant for us. First year you got gain, subsequently you got loss. That's what we've got in this problem. No? First year gain, subsequently you got a loss. So that loss, no, you will not transfer it off to P&L. First you will adjust that loss with revaluation surplus OCI. If you have a balance of here, in this problem only if you have to be very specific. First year you have got a gain of how much? 15,600. Or how much is the balance in revaluation surplus? Because you adjusted this one also. No? We'll find out the balance also. 15,600 minus 5,000, that is 10,600. Because 5,000 provision for DSR also you adjusted. No? So 10,600 balance is there in revaluation surplus. Okay. How much revaluation loss is there? 8,980. So this revaluation loss of 8,980, no, you will not transfer it off to P&L. First, you will try to adjust this with revaluation surplus. Okay. If revaluation surplus has enough balance, then entire amount of loss will be adjusted with revaluation surplus itself. Okay. Suppose, just for your understanding, if this revaluation loss, instead of 8,980, if it was 11,000, assumption, if the total loss is 11,000, then out of this 11,000 loss, no, balance is revaluation surplus is only 10,600. Out of this 11,000 loss, only 10,600 you can adjust it with revaluation surplus. Balance 400 you will adjust it off with PRL account. Okay, that's how the working happens, or treatment suggested by the standard. That's what I've just called out in the chart also here. If earlier gain was accounted, then set off that gain through OCI, meaning revaluation surplus first. If after setting off also still if you have a loss, then the balance loss goes off to P&L account. Okay. So here we have 10,600 balance in revaluation surplus. Loss due to revaluation is only 8,980. So that means the entire loss we can adjust it off with revaluation surplus itself. So revaluation loss, how much have you got? 8,980. So adjusted from 10,600. If you deduct 8,980, you're going to get 1,620. Yes, no? Correct, no? Or in fact, this is adjustment. No? 1 minute. The balance is not 10,600. This we should add. No? So this is actually 20,600. So from 2,600, if you deduct 8980, you're going to get 11,620 rupees. Okay. So that is the revised balance. Revised balance of revaluation surplus on 31st March 20x5 after all the adjustments. Got it? This is the funda. Okay, the entire loss will be adjusted off with revaluation surplus itself. Okay, so the entry for this will be, you have to reduce PP. So the entry, sixth entry will be, and the property, plant and equipment and will get reduced. So PP, if you have to reduce, means you will credit property, plant and equipment. How much? You need to reduce it by 8980. No? Okay, amount I'll write off 8980. Okay, first year, second year, third year, no entry, because this is happening only in the fourth year. What will you debit? You're adjusting this loss with revaluation surplus. So you debit revaluation surplus. So the journal entry will be revaluation surplus OCI account debit, that is 8980, to property, plant and equipment 8980. This is the funda. Okay, that's pretty much what they've asked, sir. That's all is the funda of this. How will the entity account for the above changes? That's what we have shown with the journal entry also. Okay, if it adopts revaluation model. So actually it is a very simple wala funda. Correct? Now if you want the final, one more extra also. Finally, what will come in balance sheet? Balance sheet. Okay, final balance. PP will be shown in balance sheet at okay, after adjusting revaluation loss, the revised carrying amount. The revised carrying amount of PP on 31st March 20x5 will be, obviously after revaluation you will show the asset at fair value only, no? So the fair value is 1,14,200. So it will become 1,14,200 only, even if you want to calculate. From the carrying amount 123,180, that is G, you have to reduce revaluation surplus, that is represented in J. So if you do that, 123,180 minus 8980, obviously you're going to get the fair value of 1,14,200. So the asset will be shown in the balance sheet at 1,14,200. Okay. Then you will have provision for DSR. Provision for DSR will come at 7,200. In fact, I'm showing you the balance sheet on 31st March 20x5. Yeah? That day, if you prepare the balance sheet, these components will get shown in the balance sheet at this particular value. So provision for DSR will have a balance of 7,200. Lastly, you will have under other equity, you will have a revaluation surplus. Revaluation surplus OCI. That will be shown at 11,620 rupees. Okay. This is the funda. Okay. Now, final impact, no? I said here, no, this reduction in provision for DSR, they adjusted with revaluation surplus. Even if you adjust with P&L, the final balance sheet impact will be the same. Okay. All right. More or less, like, you'll get the final asset and liability. If you net off all, you'll get the final same impact. But my suggestion is, you do like the way study material is only done. The reduction in provision, you adjust it with revaluation surplus itself. Okay. This is the funda of this particular question. So quick summary of this question is what? Okay. It is just what provision for DSR cost they have combined with revaluation. And provision for DSR cost has also reduced initially. Provision, initially you capitalize, then go on adding finance charges. 3 years you added finance charges. Okay. At the end of third year, what happened? There was one revaluation drama happened. There was a revaluation gain. That revaluation gain, you transferred it off to P&L. I mean, your revaluation gain, you booked it off to revaluation surplus OCA. That's all. Okay. Now, fourth year, what happened? Okay. Fourth year, they're saying due to technological factors, the provision for DSR, the estimated liability of yours, has reduced by 5,000. Hence, provision for DSR balance also, you need to reduce by 5,000. Normally, provision for DSR balance, you should have reduced it from the cost of the asset, because initially provision for DSR you have added to the cost of the asset. So this 5,000 reduction you should have reduced from the cost of the asset. But I told study material has adjusted this from revaluation surplus. So we'll also adjust from revaluation surplus only. So the journal entry will be provision you need to reduce, so that you need to debit. So provision for DSR account debit to revaluation surplus 5,000. That is a drama in the fourth year. After this, again at the end of fourth year, you did revaluation. But this time you got a revaluation loss. You got a revaluation loss of 8980. Okay. If there is revaluation, there is a subsequent revaluation loss, because first year you got a gain, no? Second year or third year you got a gain, fourth year you are getting a loss. So hence this revaluation loss, straight away you will not transfer it to P&L. How much ever balance is there in revaluation surplus, first you adjust that. Even after adjusting, if this loss still remains, that balance loss you transfer to P&L. Here revaluation surplus had a balance of 2600, loss was only 8980. So entire thing you were able to adjust from revaluation surplus itself. Okay. So after adjusting, nothing to be transferred off to P&L. Everything will be adjusted. So after doing this drama, I've got the balance of all the components. So this is the, in balance sheet when you prepare on 31st March 20XY, the PP, provision and the revaluation surplus will be shown in the balance sheet at that particular data. Okay. There is one more complexity if they want, they could have brought in. They have not brought in, I'm just sharing with you. If you remember, due to revaluation, I'm just sharing with you 5 minutes, problem is over. Just this extra knowledge shots. If you remember, whenever you do revaluation, carrying amount will increase, yes? Like in third year, when you did revaluation, no? You got revaluation surplus and carrying amount increased. Whenever carrying amount increases, no, depreciation also will increase. See, for the first 3 years, no, depreciation every year was 3000. Now it became 3420. In journal entry also it is getting reflected 3. For the first 3 years it is 3000. For the fourth year it was 3420. Yes, that means due to depreciation or due to revaluation, you are getting excess depreciation. Excess depreciation due to revaluation is how much, sir? Only due to, if this revaluation was not done, means depreciation would be 3000 only every year. Due to revaluation, you got it as 3420. That means you are getting some excess depreciation of 420 every year due to revaluation, right? So if this is the case, then standard gives you a leeway, one option to the company, not an obligation, not a compulsion, an option to the company in Ind AS 16 gives. What is that? If due to revaluation, if you're getting any excess depreciation, then that excess depreciation amount, no, okay, from revaluation surplus, you can transfer it off to retained earnings every year. Meaning, from revaluation surplus, the company has an option to transfer to retained earnings 420 rupees every year. Every year from revaluation surplus, you can transfer it off to retained earnings. This is an option given to the company. If company wants, they can avail it. They want, they may not avail it. This option, study material, they have not adopted. Okay, meaning they've framed a solution thinking that this option company has not opted for. If they had opted, no, revaluation surplus balance would have further reduced by 420 rupees. Here in this working note you have done, no? Okay, 420 rupees you would have transferred, no, from revaluation surplus to retained earnings. So this would have been reduced. This balance would have reduced by further 420 and done. Okay, that adjustment anyway. I'm just for your knowledge sake I told. If they don't tell whether it option is exercised or not, assume it is not exercised only. So that one less working note for you, no. So otherwise you'll have to find out excess depreciation. One more working note you need to put off. Okay. So assume that this option company has not adopted and then only do the working. It becomes a lot easier. That's what study material also has done. Okay. So now it's not much. It's quite easy only. Yes. So but if you look at study material, they've just given explained and put up journal entry. So that way you may not be able to collate it. In examination present like this, one working note. 4 years ka working note you need to put it up. That's all. PP ka working note, provision ka working note, and one small working note for revaluation surplus. Your things are done. Okay. Yes. Hope this session was helpful to you. Wish you all the very best. Take care. Bye bye.